guys, Hayden Hill here with Family First Life, and today I'm going to take you guys through a mortgage protection appointment. Now, mortgage protection has made a big bulk of my sales the last couple years in the industry. It's a fantastic product, and I really think it's one of the best things we can do for families in their time of need when their house, their condo, their investment property. Typically, in most cases, it's going to be their biggest debt, their biggest liability, their biggest asset, the biggest purchase they're going to make throughout their whole life. So we want to make sure we can put a good program into place to make sure when that day does come, they're going to be okay financially with the house, condo, whatever the case is. So today I'm going to walk you guys through a couple different steps. We're going to go through the presentation A through Z. Now, whether you're selling in person, face-to-face, over the phone, over Zoom, does not matter. There's going to be a couple little tweaks you'll make along the way, but this basic presentation is going to basically cover any way of selling to any type of mortgage client. So I'm going to go into exactly what I say, questions I ask for tie downs, and kind of the way I lead the client to the direction to get them protected with a certain product. And then from there, I'm going to talk about young people, so 20 to 40, 45, 40, 45 to about like 65, 70. And then that 65 to 85, 90 range. So young people, middle age, and older. And I'm going to teach you basically how we do that. So first thing I'm going to do with my presentation is I'm going to have the form that they filled out. And so typically I'll either have it on my phone or I'll have it printed out. And basically what I'll do is I'm going to go to the door, I'm going to call them on the phone, and basically what I'm going to do is introduce myself, tell them I'm here for the mortgage protection, go over to the kitchen table, and what I'm going to do right away after building a little bit of rapport and making sure they're comfortable is I'm going to pull out their request form. So the first thing I'm going to do is basically I'm going to say, let's say we're talking with John and Mary. Now, John and Mary, you fill out this form online or in the mail or over the phone for some information on mortgage protection. Now, were we looking to protect both of you or just one of you? So John, are we looking to protect just you, or Mary, just you, or both of you? The reason why I asked that question is it's a tie down right away. It's assuming the sale right away. And John and Mary are going to tell me right away if either one of them wants the protection. Usually it's going to be for the primary breadwinner or maybe the older person, or if they're both interested, or sometimes, and a lot of times we'll actually say, well, it depends on the price. And so I want to get that out of the way right away. From there, I'm going to verify everything on the form that they filled out. So basically what I'm going to say is, okay, great. So John and Mary, I see here that, John, you're 35, and Mary, you're 34. Date of births are this, this, and this. Is that correct? Okay, great. And then I have the loan here for, $200,000. Is that correct? Yeah, maybe it's about 198. We filled it out about 2 months ago. Okay, not a problem. And the loan, is it a 30-year, a 25, 20, 15? How many years do we have left? 30 years. So, okay, great. So from there, I have everything out of the way. We're ready to go. Verify the information. They're comfortable. They kind of know what's going to happen. And what I want to do is I'm going to show them my state license, or if I'm selling over the phone, I'm going to tell them my state license number and have them write it down. So basically, I'm going to show them, hey, this is my state license. I'm not sure if you're familiar about, John and Mary, but a few years ago, the mortgage companies stopped providing mortgage protection. They passed that job over to the insurance companies. And so me, what I do, I'm an insurance broker. Worked with over 100 of the top A&A plus rated insurance companies, and they all have specific programs to cover your mortgage for the time when something happens. And so basically the process, just like you read on the card or just like you read on the form online you filled out, is there's going to be no physical exams. We're going to most likely be able to get you approved and protected on the spot today in the next 10, 15, 20 minutes. And then once you have that coverage, it's going to be private. You're going to own that coverage. And so from there, I'm going to look at the bottom of the sheet here, my inventory sheet. And basically what I'm going to do is I'm going to talk about the difference between mortgage protection and life insurance. So I'm going to say, now, John and Mary, not sure if you're familiar, most people aren't, but are you guys familiar with the difference between life insurance and mortgage protection? Sometimes they'll say yes, sometimes they'll guess, sometimes they'll say no. No matter what they say, great, yeah, that's close to what it is, John and Mary, or yeah, hey, no problem, most people don't know what it is. The main difference between life insurance and mortgage protection, John and Mary, is life insurance typically only pays out when you die. So you either die in the term or basically it goes away and you lose it. So that's kind of going to be more life insurance. What mortgage protection is, and what you requested today, is it's going to have a couple of extra things in addition to life insurance, and it's why so many people get this to protect their house, their condo, whatever it is. So what mortgage protection is it's going to pay out, of course, when you die, but there's also, in most cases, living benefits. So the cool thing is, John and Mary, you guys are both working right now. Something happens to you, accidental death, you have terminal illness, critical illness, chronic illness. So we're talking terminal cancer, heart attack, strokes, mini strokes, anything of that nature that happens to one of you guys or both of you, it's going to pay off either the whole mortgage or a big bulk of it. So that's excellent. And then John and Mary, really cool thing is, due to your age, there may be some programs where you can actually get all your money back at the end of the mortgage if you don't get sick, you don't pass away, you don't have to use the policy, which hopefully, obviously, that's what happens. So does that make sense? Okay, great. So from there, what I'm going to do is basically go into my financial and health inventory. So the point of this thing is basically I want to see what they can qualify for. I want to have a couple tie downs for pre-closes. And then what I want to do is set it up basically for the product options, have them choose one out of 2 or 3, get the deal going, submit an application, get them approved on the spot. And so first thing, and I'm going to fill this out with you guys. The first thing I'm going to do is basically say, okay, great. So on the form that you guys filled out, the mortgage was $200,000, you said, right? Okay, great. And you said that was a 30-year. All right, and when we were talking, you said you guys refinanced. Doesn't matter if it's a refinance or a purchase. Just want to know that information. Next question I'm going to ask is, now John and Mary, what is the monthly payment on the mortgage? So let's say they say it's $1,000 per month. So I'm going to write down $1,000. And then John and Mary, when you refinanced or when you purchased the house, I'm sure you put a little bit of money down, so the value is higher than what it is now. What do you think the house value is right now? Or if they just refinanced or bought it in the last month or two, what did the house appraise at when you purchased or refinanced it? In this situation, the mortgage balance is $200,000. Let's say they say it's $250,000 is the value. So they owe $200, value $250, $250 minus $200. To get the equity, they have $50,000 of equity. So, okay, great. So John and Mary, you guys have $50,000 of equity. Fantastic. And then last question about the mortgage. Do you guys, $1,000, do you guys pay extra per month on that $1,000, or do you kind of just pay the minimum payment that you have to? And depending on what they say, just another kind of way to make sense of this. So if they say, yeah, we pay an extra $100 a month or $200 a month, I'm going to notate that, because then when I get to the end of the presentation, $100 or $200 doesn't really do them much good if something happens in the next couple of years, they get sick or they die. But if they can use that $100 or $200 towards a mortgage protection plan, it makes all the difference in the world, because something happens tomorrow, their house is getting paid off for a big chunk of it. So I'm going to notate that. Next thing, basically just name and age. So I think I said earlier John was 35, Mary is 34. And for this example, we're going to say that John's working, Mary's not, so they just want to focus on getting John coverage. So we get John's occupation, we get his monthly income. Now, whether they're both working or only one is working out of the two, what I'm going to ask them is basically, okay, great. So John, you said you make $4,000 per month. Mary, you're not working, or you're making, let's say, $2,000, $3,000, $1,000, whatever the case is. So, and this is a tie-down question that you guys got to make sure you ask. So, John, you make $4,000. Mary, you make $1,000. The mortgage is $1,000. Would it be fair to say that if something happens tomorrow to John, since he's a primary breadwinner, it would be a little bit tight and it would be hard to make the mortgage payment? And you just be quiet and let them answer. Of course, they're going to say yes, just painting the picture more to the clients. This is super important. From there, we're going to go into medical conditions. So, are you guys smokers or non-smokers? Let's say in this situation they're not. Medications, so we'll go through medications, medical conditions, and then this next part's very important. So John and Mary, I know that you guys said you don't have anything in place for the mortgage protection. Do you guys have anything at all that would help offset the cost of the mortgage, say when something were to happen to both you guys? I'm talking life insurance, 401ks, IRAs, stocks, anything like that, whether it's through work or outside of work. What do you guys have in place? Now, if they say no, that's fine. My next kind of thing I'm going to say after that is, okay, and that makes sense. That's probably why this is so important and why you guys requested it, correct? Yeah, of course. Okay, great. If they say, oh, I have life insurance. Okay, great. What? How much do you have? How much coverage? What company? Is it through work? Is it outside of work? When did you get it? How much per month? I'm just kind of taking an inventory, because If they got a product in the last couple years, or maybe something's expiring or something's going up in price, I want to make sure I have that information, just kind of loaded ammo, ready to fire, so I know how to put this family in the best situation. So I'm going to notate all that kind of stuff. If they say they have stuff through work, you know, most of you guys probably know this already, but you know, coverage through work is great when you have it. It's very cheap. The only thing that's not the best about it is when you leave, quit, or retire, it goes away. So if they say they have coverage through work, I'm going to say great, that's awesome, super cheap. I'm sure John and Mary, you guys already know though, it's kind of like a company car. When something, when you leave, quit, or retire from the job, it's going to go away. You can't keep that coverage with you. So get that. And then beneficiary, I assume you guys want to be each other's beneficiary, correct? Okay, great. So in this particular situation, John and Mary, 35 and 34. So I'm just going to go in order. I'm going to do their situation first, the young people. From there, I'm going to go to the middle-aged people and then the older people. And so on this situation, and doesn't matter their age, anywhere between like 20 and 40, 20 and 45. They're young, they're mostly healthy. This is going to be inexpensive for them. If they're not healthy, there's a lot of things going on. Maybe they have cancer, maybe they've had heart attacks or strokes or something like that, or maybe they just want to keep the budget super low. If I know that information from the form, I'm going to basically go to an accidental death product right away with return of premium in the ideal situation. The reason why is because no medical questions. They'll get approved right away. It's better than nothing. But let's say in this situation they're healthy. So what I'm going to do for the 20 to 40, 20 to 45 age range is basically I'm going to give them two options. Now I'm going to write them down on the board here. The first option, I'm going to call it traditional mortgage protection. So what I'll do here is basically write these options on the back of a piece of paper, or better yet, the back of my inventory sheet. So I'm going to draw these out, and what I'm going to do here, their mortgage is $200,000. So I'm going to write out 200, and then I'm going to show them half. So in the past, I've shown three options in terms of coverage amounts. I like to keep it even more simple these days and just do two. So in this situation, traditional mortgage protection, and then cashback mortgage protection. And what I'm going to do is show them the whole loan and then half the loan. So I'm going to go and explain it before I show the prices for those. So we're just talking about John here. He's 35 years old. So John and Mary, the way this works, traditional mortgage protection, just like you read in the form. Now, if you get approved, the way this works is it's going to protect you in the event of a death, terminal illness, critical illness, chronic illness, accidental death, and in some cases disability as well. And so this product right here, the way that it works, it's going to last 30 years. Kind of you either use it or you lose it. Anything happens in those 30 years with the mortgage, it's going to pay off your mortgage, okay? Or in this situation, most of it. Nothing happens, what you're going to do, hopefully that happens, we're healthy, we haven't got sick, we haven't died, the house is paid off now, policy ends. If you want to renew it for, you know, a different house or a property, or you refinance, excellent, but we survived, we made it out alive, house is paid off. So that's the first option. Now, our most popular option for people that are young like you guys is the option right here. It's called the cashback option. Very similar to this traditional mortgage protection. The only difference is, the main difference is two things. One, you're gonna get an extra accidental death benefit. So you pass away in a car crash, plane crash, something like that, you're gonna get an extra 100 grand for this option and an extra 50 for this, because it's gonna pay out more for accidental, okay? The main difference in these two is this one right here. If nothing happens in those 30 years, which you're young, so that's, you know, ideally the situation we would like to happen, you're gonna get all your money back at the end of the 30 years. So a lot of people use that for, you know, savings, investments, maybe the next property, whatever the case is. But the thing is, either something happens in 30 years, it's gonna pay off the mortgage, or best case scenario, nothing happens, you get all your money back. And so out of those two options right there, John and Mary, which one sounds best to you? Now, there's gonna be some people that say, well, I wanna see the prices for both. That's totally understandable. And then there's gonna be a lot of people, especially in this situation, because this just makes so much sense to me. It's what I have personally, and they're gonna say, let's go with the cashback. It doesn't make sense to, you know, waste money. We want the money back at the end. So at that point, I'm gonna show them the prices for the 200 and the 100. Basically from there, my close is gonna be, okay, great. The full mortgage, the 200,000 is, you know, $100 per month. The half the mortgage, 100,000, that's gonna be $55 a month. Based on those numbers, which option works best to protect your mortgage. So that's basically it. Very simple. If they're unhealthy, again, I'm gonna go just accidental death benefit. But if they're healthy, which most likely in this age range they will be, I'm going with these two options right here, okay? So that's gonna be the first kind of age range that we have. The next age range, we're gonna go to the middle age range. So with this next age range, we're talking age 40 or 45 to about 60 or 65. Mortgage protection is still going to be affordable. However, once we get up there, especially if the coverage is higher, it's going to be a little bit more expensive. So in this situation, let's do the same thing, $200,000 mortgage. Instead of John and Mary being 35 and 34, in this situation, we're going to say that John is 50 and Mary is 49. Mary's not working. We just want to cover the primary breadwinner, John, for the mortgage. So in this situation, basically what I'm going to ask them, because of keeping the price somewhat affordable in the ballpark for them, is I'm going to ask them, okay, great. Now, John and Mary, are we looking to cover the mortgage in the event of an accidental death only? Or are we looking to cover it more in terms of like natural death, accidental death, sickness, disability? Now, from what they say, I'm going to show them. But most people, in my experience, they're going to say, well, we definitely want to cover it, in terms of anything, natural death, sickness, etc. So what I'm going to do at that point is I'm going to actually show them three options. So very similar to the last one that I just went through. The only difference is we're going to be adding a third option. So the first option, I'm going to call this one just traditional mortgage protection. So with this one, and I always go from cheapest to more expensive. So traditional mortgage protection, level mortgage protection, and then cashback mortgage protection. So in this one, the traditional, it's actually one of my favorite products in this age range, up to 75. I think it's the best product, bar none. It's going to be America's Payment Protector. Basically what that is, the decreasing term, the mortgage is decreasing over 15, 20, 25, 30 years. So a decreasing product, it's going to be the most affordable compared to other terms, and it just makes a whole bunch of sense. So traditional, and sometimes what I'll do too is I'll draw a line so they get that. So traditional mortgage protection, and same exact numbers, 200,000, 100,000, and you can always down close or go in the middle if they say, you know what, let's cover 2/3 of the loan, or if they can't afford half, 100,000, maybe we show them 50,000, 75. Something's always better than nothing. And so the way I'm going to explain these is, okay, great. Now, John and Mary, we have three options for you. They're all great options. Now, the way these work is they're all very similar. Some are going to be more expensive than others and some cheaper. So I'm going to walk you through the three options. Whether you go one of the three or you love all of them, you can't go wrong because they're all going to protect the mortgage and do the job we're trying to achieve here. So the first one, traditional mortgage protection. You guys have a loan for $200,000 over the next 30 years. What this program right here is going to do, it's going to be the cheapest, and basically the way it works, it's going to decrease with your mortgage. So if something happens tomorrow, it's going to pay off the whole mortgage, or in this case, half the mortgage. If you have the whole mortgage covered right here, and something happens in 27 years, well, whatever that balance is at the 27th year, it's going to be pretty dang close to that mortgage. Might be a little bit more, might be a little bit less, but it's going to pay off the mortgage, or very, very close at that point. So it doesn't matter if something happens now or in year 27, 28, 29, or right before it's paid off. So that's the way this one works. The way this one works is very similar to this one. It's going to be a little bit more expensive, and this is going to be a level program. So instead of decreasing with the mortgage, it's going to stay level. So for example, the $200,000, if something happens tomorrow, obviously your loan is $200,000. It's going to pay that whole sucker off. Now, if with the $200,000 protection, something happens in 15 years, ideally your mortgage is around $100,000. Well, it's going to still pay. In this situation, Mary's going to pay you $200,000. You can use $100 to pay off the remaining balance on the mortgage, and guess what? The other $100, it's you get to keep that and do what you want with that. So this program, very similar to this one. This one, some nice features it comes with. If you get terminally ill, critically ill, chronically ill, or disabled, and then obviously pass away, it's going to pay out right away. So heart attack, stroke, cancer, paying off the house, or in this case, paying off half the house right away. So that's that one. This one right here is going to be one of our most popular, but it is the most expensive option. It works exactly like this level program. The only difference is with these two, you don't get your money back if you outlive the mortgage. With this one, you do. So the way it works, John and Mary, after 30 years, nothing happens to you guys. you guys get every single premium you paid month in and month out for the last 30 years back at the end, tax free, plus any interest. So it's a fantastic product. So prices on this and this is here for these two options at this and these two options at this. Based on, you know, those three right there, which one do you like best? And maybe they say, you know what, we like the traditional one. Great, that's what most people do. You know, do you guys want to protect the whole thing, or do you want to start with maybe a little bit lower and protect half? With this one, usually if they're going to go cheaper, they're going to go for the whole thing. Now with these ones, since they don't decrease and they stay level, sometimes they might choose 100,000, the half option in this situation. Maybe they'll choose, you know, 2/3, 150,000, and they'll want to see that. But that's basically the basis of my presentation. And sometimes what I'll tell them too is if they're trying to keep it affordable and they want to start with this, but they love the cashback. Like most people love the cashback. It just makes a lot of sense, but sometimes it doesn't exactly fit that budget. Basically, if they ask me, hey, can I, you know, upgrade to the cashback down the line? My answer is always yes, 100%. As long as you're, you know, healthy enough, you stay in the same situation now, we can try to get you qualified for that. So if you want to go ahead and start with this for now and then upgrade to this down the line, we can definitely see if that's an option. So that's going to be those middle range clients, ages, you know, 40, 45 to about 60, 65. And then the last one, which is one of my favorites, probably the most challenging, advanced presentation for new agents and agents that just haven't really ran mortgage protection. And this is going to be the senior mortgage protection. So in this situation, we're talking about people age, you know, 60 or 65, all the way to 90 now. And so as you can imagine, covering a $200,000 home at age 85, 88, 90, it's gonna probably be more expensive than their mortgage at that point if they can qualify. What we're gonna do is show them some other options to make this make sense. So in this situation, it's gonna be a little bit different. Let's say same situation, $200,000 mortgage. Only difference now is John and Mary, they are, let's go age 75 and 74. John's working still, Mary's not, they just want to cover John. So I'm going to run through this whole inventory sheet. And basically when I get to the end, I'm going to ask them a very important question. Now, whatever way they answer this question, it's always great, that's perfect, that's what most people say. But what I'm going to ask them is, okay, so John and Mary, you guys have a mortgage of $1,000 a month. You guys are 75 and 74. Now, I don't know if you guys have thought of this, but what's going to happen tomorrow, John, if you don't make it home, if you pass away? Mary, are you going to sell the house and maybe downsize or move? Or are you going to stay in the house? What are we thinking? Are we going to stay or are we going to sell? The reason why I asked that question is because if Mary says, and in most cases, guys, with a higher mortgage, it is this answer. Mary's going to probably say that she's going to sell the house. Why does she need a big house? If John's not there anymore, she's probably going to downsize. So if she says, you know what, I'm probably going to sell the house, perfect. That's exactly what most people say. And now in my head, I'm just thinking, I'm going to tell them this and project this to them, but covering a $200,000 mortgage, if she's going to sell it, doesn't really make much sense. Now, maybe they say, you know what, we don't care what the cost is. We love those clients too, obviously. We'll cover the whole thing. But in most cases, she says she wants to sell. It's going to make sense to them. Now, John and Mary, you guys owe $200,000 on the mortgage. Most people in your situation, what they'll do is they're going to put in place something called equity protection. So if you want to cover the whole loan, I can certainly show you that. It is going to be expensive, most likely close to your mortgage payment, if not more. Great product. It's a lot of protection. But if Mary, if you're going to sell the house anyway, it doesn't really make much sense to cover that because we already have $50,000 of equity right now. Hopefully more in the future when something happens, John, to you. But what we're going to make sure with this equity protection is we protect that hard-earned equity. And when something happens to you tomorrow, John, it's going to give Mary a certain amount of time to kind of recover and figure out what's best for her situation. So with the equity protection, what we do is basically we put in place a program that is going to cover 6 months of the mortgage payments, 9 months of the mortgage payments, or the whole year. Now, John and Mary, this is just what most people do, 6 months, 9 months, or 1 year of mortgage protection with the equity protection, because what they realize is, John, if something happens to you, The market's hot right now. We don't know what's going to happen in the future, but in 99.9% of cases, Mary, if you're going to sell the house like you just said, in 6 months after John dies, in 9 months or 1 year, you can certainly, most likely, sell that house, be okay, take the equity, take a big check from that, move on to your condo, your apartment, your small home, whatever the case is. But the point is, John, when you die, Mary's going to be struggled. She's going to have, it's going to be a crazy time in her life. But financially, if when you pass away, if she can get a check for 6 months of mortgage payments, right when you die, 9 months of mortgage payments, or 1 year of mortgage payments, it's going to make that whole transition so much easier for Mary. It's going to be less stress, and she's going to have a lot of time to decide if, she wants to list the house and sell it, or maybe, she decides she doesn't want to sell the house. She wants to refinance. Maybe she's going to move in her sister from the East Coast and they're going to live together. Maybe she's going to put more for savings or checking money down in the home and make it a cheaper payment. Whatever the case is, it's going to give Mary enough time so she doesn't have to sell the house in a few months and be going a million miles an hour while having to deal with the burden of, John, you passing away and the feelings that come with that in the family. So this is the equity protection. Now, what most people do is they will do the full 1 year just because that's going to be a perfect amount of time no matter what the market is. Now, some people, they'll do 9 months. Other people will just get their foot in the door and they'll start with 6 months. Down the road, maybe they'll qualify. But even with the 6 months, they still know something happens tomorrow, Mary, you're going to be okay covering the mortgage for 6 months. Now, some additional things that will help with this program besides just when you pass away is in most cases, obviously depending on the product and the carrier, if you pass away in an accident, this amount's actually going to double. So if you have this 6 months and John, you pass away in an accident, it's going to be a year, it's going to be 18 months, year and a half, and then 2 years. One more thing is, John, if you ever become terminally ill, so we're talking terminal cancer, brain disease, anything like that, it's going to be deemed by the doctor you have less than 12 months to live, they'll actually give you access to half the money up front, just so it can help out with medical bills, and maybe you guys can start to plan in advance because you know the inevitable is happening. So based on that information, John and Mary, for the equity protection, when you pass away, John, do you want to leave Mary a check to cover the mortgage for 1 year, 9 months, 6 months? Or do you want to look at something a little bit longer, maybe like a year and a half, 2 years, or 3 years? I'm just going to be quiet. I've had a lot of situations where older people, they realize that this is kind of the last chance to get that coverage in place and keep the cost, lower than if they were to wait, especially with medications, 1 or 2 more medications, 1 heart attack, 1 COVID case, something like that. It could be really hard to get insurance coverage, mortgage protection in the future. So I've had people say, you know what, let's look at 2, 3, 4 years. That's awesome, excellent. But these are going to be the most common coverages someone's going to choose. And so hope that helps, guys. That kind of just took you through how we go through mortgage protection with the younger crowd, the middle-aged crowd, and then the older crowd. To wrap up, basically what I'm going to do, we go through the application in any 3 of those situations. We get them approved on the spot. I'm going to leave them with a folder, or if I'm selling over the phone or over Zoom, I'm going to send them a text message and an email with the information. But what I'm going to do is leave them with the folder of the carrier. I'm going to circle the carrier picture on the form. I'm going to write down the policy number. I'm going to write down how much coverage, how many years, what the cost is, what day of the month the draft is. Leave them with a business card. If I'm, like I said, if I'm selling virtual or over the phone, I'm going to send them information and let them know, John and Mary, I'm here for you. I'm going to be, the agent assigned to you for this policy. If anyone calls and they, ask any questions or try to get you another policy, call me. We don't want them messing up the policy that we chose, and we don't want any declines or anything like that on your record. So you call me, and then if you decide in the future that you want to upgrade from this to this, or in the other situations, half the mortgage to the full mortgage, or the regular one to the cash back, you just call me. I'm here for you. I'm going to help you, and then from there we're good to go. So hope that helps, guys, and we'll see you next week.